Hello everyone and welcome to Fun with Fitzy. This is Chapter 9, Video 1. Chapter 9 is a pretty fun chapter. We're talking about different receivables and lots of the stuff you know from grade 11, recognizing the account receivable part. However, there's a few new things that I think are pretty fun that we're going to be discussing. We're going to be talking about credit cards and bank cards and how to recognize those as well in this chapter. So Chapter 9 is a pretty fun chapter. Today's video we're going to talk about recognizing receivables. And this chapter, there's three things that we need to talk about. One is recognizing, one is valuing, and the other one is disposing. So we're going to break it up into 3 or 4 chunks here, and we're going to go at it bit by bit. So you know receivables refer to the amount of money due from individuals and other companies. They are claims expected to be collected in cash. Okay, these are our assets, receivables. Money that we expect to receive. And there are 3 major classes, and we didn't talk about the classes of receivables in grade 11, but we're going to talk about them now. One is accounts receivable. You know of notes receivable now because we talked about notes payable. And of course, there's other receivables. And we'll talk about other receivables towards the end of this video, but just to give you an idea of what some other receivables are. There are interest receivable, on your notes receivable, and there is things like HST recoverable. Although we treat HST recoverable as a contra liability, it still is a receivable. So there are 3 primary accounting problems associated with accounts receivable, and like I said, one is recognizing. Now that is just basically the journal entry that we do when we realize we have an accounts receivable. Valuing accounts receivable is a new topic for us. It's kind of like valuing our inventory in our last chapter. Well, sometimes we need to value our accounts receivable as it ages because we're not always going to be able to collect it all. It's one of the costs of doing business. And then, of course, disposing of accounts receivable. That means getting rid of it. So we'll be talking about these 3 things. So first of all, we're going to talk about recognizing accounts receivable. This is not new to you. So when a business sells merchandise to a customer on account, accounts receivable is debited and sales is credited. You know this already. Nothing new. Debit accounts receivable, credit sales. That's how easy recognizing accounts receivable is. Now, when a business receives returned merchandise previously sold to a customer on account, we're going to debit sales returns and allowances, and credit accounts receivable. And we talked about this in chapter 6, I believe. This was the periodic method of inventory. A little bit different from the perpetual. And recognizing accounts receivable when people pay, when we collect the cash from a customer. So if we look at these 2 different journal entries, one, we sold $1,000, they returned $100, so we still are owed $900. So in this case, the customer's paying us $900, so we're going to debit cash and credit accounts receivable. Nothing new, all grade 11 stuff here. Now, what we need to talk about is financing charges are added to a balance owing. This part is new. When you have accounts receivable and customers do not pay within the 30 days, you're going to start charging them interest, and there's going to be an interest based on a percentage. Now, we're going to use an account called interest revenue for that. Now, notice here, we are not using interest receivable, we are using accounts receivable. The reason for that is, could you imagine if you're somebody like Bell Canada that has millions of customers, and every time somebody paid late, you added an account called interest receivable. So you would have an accounts receivable for each customer and an interest receivable account. Doesn't make sense. So we just keep adding that interest to the amount that the customer owes us. So now this customer, we've added $13.50 worth of interest that they owe. They owe us more money now. So that account receivable is debited. So I'm going to go over to a notebook here and we're going to look at it. So here is an example of a journal entry. Fitzy Company sells merchandise on account to Nintendo on July 1st for $2,000. So accounts receivable and sales. Now I'm leaving HST out of here to make it simplistic, and also in this particular case we are talking about the periodic system versus the perpetual. Remember, in the perpetual, we would have to we would have to have a second journal entry that recognizes the cost of goods sold as a debit and merch inventory as a credit. So we're looking at the periodic to keep things simple. Okay, so that was the first transaction. Now, Nintendo returns $100 to Fitzy Company on July 31st. So again, we're going to use sales returns and allowances as our debit, and we're going to credit accounts receivable. Now, how much do they owe us? Well, if we had an accounts receivable here, and it used to be $2,000, and then they returned $100. Now, oops, sorry about that. Now they owe us $1,900 at this point. So we received payment from Nintendo of the balance, and we know it's $1,900, so we're going to collect that cash, and we're going to credit that accounts receivable now of $1,900 because they paid off their account. We should have a zero balance here. Right? Make sense? Pretty easy. Now, if Nintendo still owes us $900, now this is hypothetically because they did pay us off, we're going to add an interest charge of 18%. Now, remember from when we were doing notes payable, our interest was always expressed annually. They're not late for a year in this case, they're only 1 month late. So we're going to have to do the journal entry that we just talked about, adding the more money to the accounts receivable and collecting interest revenue. So here is our interest revenue. Let's do that math for you though. So 900 times 0.18, so that's our face value, times our interest rate, times 1/12, if I'm correct here, should be $13.50. So in fact, we're right. So remember this formula, it applies to interest on receivables, all receivables, notes payable, notes receivables, and in this one. And there we go again. There's our interest calculation. So now let's spend some time talking about notes receivable. We spent some time talking about notes payable. It's very simple. A promise to pay is basically what a note is. A promise to pay money. So a promissory note is a written promise to pay a specified amount of money, and it's on demand. What this means is that customers can demand their money back, or the supplier. In this case, if it's a note receivable, we can demand the people we lent the money to at any time to get the money back. It doesn't happen very often. The person making the promise to pay is the maker, and the party to whom payment is made is the payee. So the promise to pay, the people who borrowed the money, are the maker, and the lender is the payee. So the borrower is the maker, and the lender is the payee. Probably a term you guys should remember. Now, with respect to recognizing notes receivable, let's look at this example. Wilma Company receives a $1,000 6% promissory note due in 2 months from Brent Company to settle an open account. Now, in this particular case, we are just going to, and this is on May 1st, recognize the note. So the $1,000 is going to be notes receivable. And in this case, it's been converted, an accounts receivable has been converted. You'll notice here it said to settle an open account. Well, in this case, Brent Company owed money to Wilma Company, and we're not ready to pay within the 30 days. So they converted it, said, listen, we need 2 more months to pay this money, and Wilma Company agreed to it. And therefore, there was a promissory note written, and Brent Company now owes $1,000 to Wilma Company. And it's now converted to a note. Now, what we have to consider is when the year end is. If the year end falls in here, we're going to have to do an adjustment that we talked about in Chapter 3, but we'll have to wait and see. Now, we talked about the 3 types of receivables, was accounts receivable, note receivable, and other receivables. Well, the other receivables I talked about already was HST recoverable, Interest receivable you get on your notes and accounts receivables. Sometimes you loan money to company officers. You may give your employees an advance on their pay, and all of these will create receivables in your books. And these are just other ones other than accounts receivable and notes receivable. So very simple. Recognizing accounts receivable was quite a review from grade 11. So you should be able to journalize in order to recognize accounts receivable, notes receivable, and other receivables. We're going to spend more time talking about valuing receivables and disposing of, and we'll spend more time on the notes receivable piece if there needs to be an adjustment for interest. Hope that helps, and thanks for watching, and we'll talk soon.